Welcome to our deep dive into the Limited Liability Partnership Act, 2008. This legislation, enacted in India, revolutionized the way partnerships operate by introducing the concept of limited liability for partners. The act came into force in stages, starting from March 31, 2009, and covers the formation, regulation, and management of LLPs. Extends across the whole country and provides a flexible business structure, combining the benefits of both a partnership and a company. In this video, we'll break down the key chapters, definitions, and core concepts, making it easy to understand how LLPs work and why they matter for entrepreneurs and professionals. Let's begin by exploring the basic framework and scope of the Act. Now let's clarify some essential terms and structure under the LLP Act. An LLP is a body corporate, distinct from its partners with perpetual succession. Partners can be individuals or corporate entities but must meet eligibility criteria such as not being insolvent or of unsound mind. The Act defines roles like designated partners, who are responsible for compliance and must obtain a designated partner's identification number. LLP agreement governs mutual rights and duties, while the registrar oversees registration and changes. The Act also introduces the concept of small LLPs with specific financial thresholds. Understanding these definitions is crucial for anyone considering forming or joining an LLP, as they set the foundation for legal and operational clarity. Let's move to the formation and registration of an LLP. To incorporate, at least two persons must subscribe to an incorporation document, which is filed with the registrar along with required statements and fees. The registrar, after verifying compliance, issues a certificate of incorporation, making the LLP legally recognized. Every LLP must have a registered office for official communication. Act sets rules for nomming, reserving, and changing the LLP's name, ensuring it's unique and not misleading. Penalties are imposed for improper use of the LLP name or noncompliance with registration requirements. This process ensures transparency and accountability, making LLPs a reliable business structure for professionals and enterprises. Next, let's examine the rights and liabilities of partners in an LLP. Partners are agents of the LLP, not of each other, which limits personal liability. The LLP is responsible for obligations arising from business activities, while partners are only liable for their own wrongful acts. The Act allows for transfer of partnership interests without dissolving the LLP. It also addresses situations like cessation of partnership, registration of changes, and penalties for noncompliance. In cases of fraud, liability becomes unlimited and whistleblowers are protected. These provisions ensure a balance between flexibility and accountability, making LLPs attractive for those seeking limited risk and operational freedom. Finally, let's talk about financial disclosures and compliance. LLPs must maintain proper books of account, prepare annual statements of account insolvency, and file annual returns with the registrar. Audits are required unless exempted by the government. Penalties apply for late or false filings, and the registrar has powers to inspect documents and obtain information. The Act also provides for compounding of offenses, destruction of old records, and enforcement of duty. These requirements promote transparency and trust, ensuring LLPs operate responsibly and within the law. By understanding these compliance obligations, partners can safeguard their interests and maintain the LLP's reputation.